Good Tuesday to everyone. It is Tuesday, March 3, 2026. And thank you for being on the other side once again.
Great to be here with you.
Today, we are going straight to the point. What is the current market situation and where could it go? We are currently in a context where several forces coexist.
Right, massive forces all pulling at the same time.
Exactly. I mean, on one hand, you have expectations on interest rates and inflation data setting the pace, and on the other hand, corporate earnings that will define if current valuations are justified.
And the market is incredibly sensitive right now.
It really is. Every macro data point moves the indices. Some sectors show real strength, energy, industrials, certain tech, while others lose momentum. The key is whether flows continue into equities or rotate to defensives.
Which is the trillion-dollar question.
Yeah. So the ultimate question for you listening is this. Are we in a pause within a bull trend or the start of a correction?
That's the perfect framing, honestly. Because Wall Street is largely optimistic about the rest of 2026. But if you look under the surface, the underlying market structure is undergoing a massive, very complex transition.
And that is our mission for today's deep dive. We are taking a stack of major institutional sources. We're talking research from Morgan Stanley, JP Morgan, Goldman Sachs, BlackRock, Vanguard, and even technical analysis from Wyckoff SMI.
A very heavy stack of reading.
Oh, absolutely. But we're going to distill all of it to find the most probable scenarios. Let's not waste any more time. Let's go.
Let's do it.
Okay, let's unpack this. We have to start with a technical standoff. It's like a coiled spring right now.
It really is. If you look at the price action in early 2026, it's historically tight.
Yeah, the two biggest ETFs in the world, the SPY for the S&P 500 and the QQQ for the NASDAQ 100, they have been moving completely sideways.
Just chopping back and forth.
Exactly. The SPY is trapped between $676 and $698. That is a 2.65% band. For the S&P to move that narrowly, it's crazy.
It builds a lot of pressure. And our Wyckoff SMI sources give us great context on why this matters.
Right, the Wyckoff method.
Yeah. For those following technicals, this tight sideways movement looks like reaccumulation.
So institutions buying.
Precisely. It implies large players are quietly buying, digesting previous gains. It's not distribution. They aren't dumping shares.
But the surface doesn't tell the whole story, does it? Because underneath, there is a massive rotation happening.
And a huge rotation.
I mean, the QQQ looks okay on the surface, but it's actually very vulnerable at its $583 support. And the sources point out that only 51% of its stocks are actually in individual uptrends.
Right, the internal breadth is weak. But what's fascinating here is that the money isn't leaving the market.
It's just moving around.
Exactly. When sector ETFs break out while the broader indices consolidate, it indicates institutional repositioning. It is not a panicked risk-off behavior.
Yeah, they are rotating into cyclicals and defensives. Energy, tracked by the XLE, is breaking out. The sources specifically mention NBR entering an early markup phase.
Neighbors industries, yeah.
And healthcare names, too, like GKOS and MRK, showing stable leadership.
They're seeking safety, but they are staying fully invested.
Which perfectly explains Wall Street's insane bullish targets for the end of 2026. JP Morgan, Morgan Stanley, they are universally bullish. The median target for the S&P 500 is around 7,650 to 7,700.
Which is about a 12% jump for the year.
Yeah. Oppenheimer is calling for 8,100. Deutsche Bank is at 8,000. Morgan Stanley is at 7,800.
And Morgan Stanley explains this using what they call the triumvirate. 3 pillars holding up the market.
Rate cuts, deregulation, and fiscal stimulus.
Exactly. Monetary policy with the Fed cutting rates, corporate deregulation boosting margins, and massive historic fiscal stimulus.
Here's where it gets really interesting, because you can't talk about fiscal stimulus without talking about the One Big Beautiful Bill Act.
The OBBBA.
The OBBBA passed in July 2025. And just to be completely clear to you listening, we are strictly impartial here. We are not taking political sides.
Not at all.
We are just analyzing the economic impact of the legislation purely based on what the institutional sources are telling us.
Right. And strictly on the math, the OBBBA is a structural game changer. It implements a $129 billion corporate tax cut spanning 2026 and 2027.
Massive injection of capital.
Huge. Plus, it restores immediate R&D deductions. And for consumers, a $10,000 annual deduction for auto loan interests.
But the real kicker, the part Goldman and JP Morgan are obsessed with, are the Trump accounts.
The mandatory contributions. This is structurally profound.
Yeah, mandatory contributions for minors that must be invested in U.S. index funds, specifically the S&P 500.
It creates a relentless passive flow of capital. Essentially provides a structural floor for the SPY ETF.
It's forced buying. Millions of accounts buying every single month, no matter what.
And on top of that structural retail floor, you have the corporate AI CapEx boom.
The capital expenditures for artificial intelligence, Goldman Sachs and Morgan Stanley estimate a $3 trillion data center build-out.
And only 20% of that has been deployed so far.
That's the crazy part. And companies are terrified of missing out. The sources call it OBBBA, the fear of being obsolete.
OBBBA is a very real driver. It is forcing companies to just keep spending billions, which drives earnings for the whole tech infrastructure sector.
It's an incredible setup for the bulls. But before we get into the risks, because there are some massive red flags we need to cover, I want to take a quick second. If you are liking what you're hearing today, we invite you to subscribe to the channel, leave a like, and comment on what topics you'd like us to tackle in upcoming deep dives. In the description of this deep dive, you'll find a PayPal link if you want to support this project. Your contribution helps us a lot to keep making content like this. We only ask for the price of a coffee. Thank you for your support.
Absolutely, thank you. Now, we do need to look at the bear case, because as strong as those tailwinds are, the risks are just as historic.
Let's start with valuations. The Shiller PE ratio is over 40 right now,
Which is staggering.
a level we've only seen during the dot-com bubble.
This raises an important question. If the market is priced for perfection, what happens to the underlying economy? JP Morgan is warning of a multidimensional polarization.
Also known as the K-shaped economy.
Exactly. The wealthy consumers are driving spending, but the working class is severely strained.
And you see it in the labor market. Unemployment has ticked up to 4.4%.
And even worse, non-healthcare job growth has actually turned negative.
For the first time in 25 years outside of a recession, if you aren't hiring nurses or doctors, the economy is shedding jobs.
Which is exactly why JP Morgan still assigns a 35% probability of recession.
And then there are the geopolitics and the Fed. We have a Supreme Court case happening right now regarding presidential influence over the Federal Reserve.
Plus a new Fed chair term starting in May 2026.
The ICG research explicitly warns this could trigger massive bond market volatility.
Right. And historically, we also have to respect the midterm cycle.
The midterm curse.
2026 is a midterm election year. Historically, the second year of a presidential term is the weakest.
What does that usually look like?
It typically features a spring pullback, a lot of summer choppiness, and then a sharp decline into an October low.
But then it rips higher, right?
Yes, followed by a massive 47% average rally into the pre-election year. But navigating that volatility is tough. Vanguard's research puts it perfectly. They warn that the market requires a shift from passive sailing to active rowing.
Passive sailing to active rowing. I love that. So what does this all mean for the listener's portfolio? Let's look outside of just U.S. equities. Let's talk commodities and credit.
There are some massive surprises in the commodities data.
Huge surprises. JP Morgan is surprisingly bearish on oil.
Very bearish. Despite all the tensions in the Middle East, they forecast oil to drop to $58 a barrel in 2026.
Which sounds crazy until you look at the supply side.
Exactly. It's about global offshore drilling and global shale. Argentina's recent boom is a great example. This is producing price inelastic supply.
Meaning they have to keep pumping no matter what the price is to pay off the infrastructure.
Right, and that supply is outpacing global demand by 3 times.
But gold is the exact opposite. Gold is a massive buy right now.
With a target of $5,000 an ounce.
Driven by central bank purchases and deep investor anxiety over U.S. debt sustainability.
And if you're looking for yield, BlackRock and Vanguard are heavily pushing high-quality fixed income and high-yield debt.
Because bonds are finally paying out, U.S. 10-year yields are expected to range between 3.5% and 4.0%.
You're getting compelling real returns, especially if the AI boom we talked about ends up disappointing or just taking longer to monetize. Fixed income is a great cushion.
So to summarize today's deep dive, the market is in this incredibly tight sideways squeeze, caught between incredible fiscal tailwinds, the OBBBA legislation, the AI spending boom, and very real macroeconomic risks.
Softening labor, midterm volatility, and dot-com level valuations.
Exactly. It's an unprecedented tug of war.
If we connect this to the bigger picture, it leaves us with something really important to think about. If the new OBBBA Trump accounts mandate billions of dollars in perpetual forced buying of S&P 500 index funds every single year for every child in America, will traditional valuation metrics like the Shiller PE ratio ever matter again? Have we artificially engineered a stock market that mathematically cannot crash the way it used to?
That is the perfect thought to end on. And with this, we reach the end of today's deep dive. We hope you liked it, that you learned something new, and that you'll join us for the next one. Thank you very much, and we will meet again very soon. Remember that in the description of this video, you will find PayPal in case you want to help us out. Thanks once again. Greetings.